Hello, everyone. Welcome back to the Market Chat. My name is Richard Moglen. Joining me today again is Jim Roppel, hedge fund manager and CANSLIM legend. Jim, thanks so much for coming back to the show. We really appreciate you coming on.
CANSLIM legend. That's pretty big. I certainly don't feel like one after all the mistakes I've made over 30 years, but I'll take it.
That's why you are one, of course. Well, thanks so much for coming back. We really appreciate it. And for this interview, you thought it best to ask people on Twitter kind of their questions to kind of get their feel for what to talk about. So I've got some questions there. We'll talk a little bit about your background, your daily routine, market conditions, how you manage stocks, crypto, of course. And we'll wrap things up by talking about a monster stock that you traded, BIDU, way back in 2009. So how's that sound?
Let it rip, brother.
Awesome. So we covered your journey, your trading journey, pretty in depth last time. So I don't want to spend too much time on it, but can you just give a brief summary about your journey thus far and what you're currently doing?
It's been an astounding journey. I mean, I went from a kid who had dyslexia. I was in LD classes all the way into college, came from very lower middle class background to getting into the business as a retail stockbroker, cold call jockey, knew nothing about how to invest, not a clue, taught myself CANSLIM, saw Bill O'Neill. I can't believe, over 20, 30 years, I probably saw him twice a year. So do the math on that. Taught myself how to trade, got a loyal following because I made money for them through many cycles. And then I had the, trust of people. Here's the thing. When you want to start a hedge fund, most people are either great traders or they know a ton of rich people, but very few people have both. And you have to have both to get rolling. And I, coming from nothing, it took me 15 years to get that together. So it took a lot of time. And along the way, the blow-ups I had and the mistakes and the beatings I took, losing all my money multiple times. So then started the first hedge fund with about 15 million, expanded rapidly. It grew. I thought I saw a really big opportunity coming in smaller cap ideas. So I started the small cap fund. I was really well aware of Eve Bobach. So she came along and started running the small fund for me. I risk managed that. So that kind of blew up now. And then I have a really dear friend who passed away last summer, who was my caddy, he was a caddy, but he was on my bag all the time and taught him how to trade. He got super involved in cryptocurrency, and he was living with us when he was recovering from cancer, oddly enough, and basically got me into crypto. We jointly started another hedge fund with, again, $15 million. That's exploded to almost 100 million. So, the journey from a kid growing up in a house that cost $7,000 to where I am today is long, full of amazing bruises and beatings and a couple big wins. So how about that?
No, that's great. And people were curious about your worst years when you're just starting out and learning CANSLIM for the first time. So yeah, tell me a little bit about that, and also how you dealt with that psychologically, because that's got to be tough to have to learn this all for yourself. And there was no YouTube, there was no real way to learn it except through experience at that time.
The beatings were so hard to take because I felt like, the underprivileged athlete who doesn't make the pro football team, breaks his leg. And I wanted it so badly. I was not giving up, no matter what, no matter how much I lost, no matter what stupid thing I did. And I felt like Bill O'Neill was really talking to me. Like, I coach so well. And through seeing Bill and sometimes getting a sidebar with him to ultimately having conference calls with him many, many times, I coach so well. And he took an interest in me. I think initially it was my imagination, but later on, a lot of, calls we had. So I learned from him everything. And that's really what makes me want to give back. Like, I taught my partner, Matt, how to trade. And then he came back and we did the crypto fund together. Bill taught me. Growth Stock Mentor is really about giving other people what I was so lucky to receive. I mean, obviously Bill's a hell of a lot better than I am, but I have, I think, something to offer people who are just starting out. And
Of
that was the
course.
genesis of that.
Absolutely. And what were some kind of key concepts that starting out you wish you knew right away? What were some stuff that you learned within those first few tough years that would have completely sped up your learning curve?
Well, only in like the last 5, 10 years did I start to really understand money management and
Right.
psychology. Like I
Hmm.
omitted the psychological aspect, which is the apex. That's the top part, which it took me getting beaten like a dog to finally realize I have these, demons rolling around in my head that are causing me to do these utterly ridiculous things at critical moments. Um, you know, the obvious early on, I got cutting losses pretty quick as soon as I started to pay attention to Bill.
Right.
But the experience of having a whopper position on and it's up massively, but you want to harvest the gain, but it could go way bigger, cutting some big monsters short,
Hmm.
just experience of dealing with position size, drawdowns, uh, gap downs. You own a semiconductor company and the factory burns down overnight. You wake up and it's gaps down 20%. You got to deal with this stuff. It's only through the highest level of the pyramid is only earned through getting crushed over decades. You just learn more and more and more. You never learn it all. And you're always improving, getting to the higher point in that pyramid.
Hmm. Hmm. Absolutely.
So I have a
And
ton to learn. Like I can't possibly believe how much I've learned in the last 5 years. I've been doing
right.
this for 30 years.
Right. No, that's so true. You're always learning. I mean, I'm so new at this, but it's great to see that you've still got that mentality. You have to be a student as you approach the market and always willing to take something from a new trade, I think.
For
Yeah.
sure.
Yeah. So I think it'd be helpful for the people because not everybody is kind of the pure position trader holding for as long as you can as you are. So I think it's helpful for people to hear maybe some basic stats that might kind of help describe your trading. So what do you think your batting averages, your average gain, average loss, and also your kind of holding periods on average? You can do ballpark numbers for both winners and also losers.
All right. I'm generally wrong as much as 6.5 or 7 out of 10 entries.
Right.
In a raging bull market like this, the batting average goes up because the wind is in everyone's sails.
Right.
But that's not always good because then sometimes I'll get in a laggard and it's up, but it's not up. I'm not in the real leader.
Mm-hmm.
I'd actually kind of rather get stopped out right away and redeploy the money in a leader. So my average loss probably is about 5%, half of 1% of equity of the whole fund. And my average gainer, I think last year I made like 80% of my money in 4 names. And I probably made, I don't know, I probably turned my account over like 6 times last year, maybe 7. As I've matured and managing more money, I'll just tell you this. Short-term trading does not scale.
Mm-hmm.
It does not. And I kind of beat up on a lot of smaller names. Like the sweet spot for me is probably like north of a 10 billion, $15 billion market cap is the lowest end of what I can deal with. But I'm like omitting that I made a crushing killing in all these names that were $2 billion a million years ago. And that's not fair. I built my war chest up in those names using heavy margin. But when you start running millions, tens of millions, hundreds of millions, it does not scale. Just look at Stan Drunkenmiller, okay? The GOAT, he is the Tom Brady of hedge funds, and he's knocked down 30% a year. So when you hear about the national champion who was up 900%, I guarantee you he was using small amounts of money and crazy heavy margin. That is not repeatable with large amounts of money. Size kills performance. So my holding period, losers can be minutes. Literally, I've when I used to call the floor, a guy would call me back. One time he called me. He's like, "Yeah, I feel." I said buy 100,000 or whatever, and he goes, "I got it 20 cents cheaper." I go, dump it all right now. He's up. This is the call telling me you're confirmed. He goes, "What?" I go, "Just blow it out."
Right.
I knew some whale was feeding me. 3 days later, they missed earnings and it imploded. Somebody else knew. So short term is always a loser. I'll cut these things out instantaneously. I probably will not carry a loser for more than, even if it's down 3, 4, 5%, I won't carry it for more than a week max, 2 weeks tops. My average monster, let's just break this down. Stocks go up because of new information. That's an earnings beat and a raise. So that when the market gets the new information, it factors that in, price goes up. If you want to get a crushing life changer, like BIDU, we'll talk about that at the very end. I think I sat through 8 reports.
Right.
Okay. Anybody, unless you're trading uber tiny stocks, you're not going to have a 100, 200% gainer in a mid cap stock unless you're sitting through multiple reports. The definition of a killing is sitting through 4 to 8 blowout beat and raise quarters. That's going to change your life. So did I get all the stats? Is that, I can answer more.
No, I think that pretty much covered your average gain, average loss, and holding periods. Like you said, losses, you're trying to, you want that basically to stop you at that first day if possible.
Hopefully, that'd be best.
Yeah. And you want to hold for your winners as long as that kind of average 18 months for a true market leader, I assume, or at least until it really, the story changes based on the earnings, basically, right?
And the market cycle, like, you can get tangled up in things, and then it may continue to have blowout numbers, but if you get into a bear market, the tide's coming in and you're baked. But the losers, look, you want to get rid of those cancerous relationships ASAP, personal life, stock market, whatever. Blow the cancer out.
Right. People were very curious about your routine. So you're famous for your ride the wave plan that you put together every weekend. So could you describe your weekend routine all the way from monitoring your positions, scanning, and then how you build that final battle plan so you're ready for that next week?
Good definition. Battle plan. That's what it is. Okay, so Friday comes around and I just want to blow out and party huge and blow out the steam. Play golf on Saturday, play golf Sunday morning. But around noontime, on comes the battle plan preparation. And that's tear through hundreds of charts, all the indexes, all the currencies, all the commodities, all the TMLs, my watch list. And I found this tonight to show you guys BIDU. But this used to get FedExed to me every Sunday. 2,000 page or 1,000 pages. And I would go through every chart in here. There was no online. This was what you got. And it organized by the leading sector, the leading stock, first to end. And I would go through every page and this taught me how to do it. So it goes through every economic indicator in a graph, all the commodities, all the leaders, all the sectors. And I really miss it because now when I screen or I do my watch list, it's sorted by relative strength, but then I can't see the low RS sectors shaping up, bottoming, accumulation at the lows.
Right.
There's a lot. O'Neill guys, pay attention, reissue these. I know it'd be expensive, but do it. So I sit, anywhere from 1 o'clock, I probably do four hours plus every Sunday. And I do everything from my temperature on the market on a 1 to 10 scale to general market conditions, short, intermediate, and long term. My view, I'll put, random comments about the VIX and institutional accumulation and money flows and just everything. Currencies and even politics that are affecting the market. Don't use politics to form your market position, follow the trend. Politics have made me lose. I got very political in 2010 through 14 and geopolitically oriented, and having a global macro view. It's hard to have a positive global macro view. And it got me way off track. When the central bank started a quantitative ease, it really threw me off, and I had 2 bad years in there. But focus on disruptive technologies. Before the world comes to an end, we'll probably have flying cars and we'll be, getting on our scooter and going to Mars. Okay. I do feel that the global macro picture is so ugly and toxic that it's going to end horribly bad. And that's probably why crypto is ripping. That's why I expect the dollar to come down. But what I learned was when the BOJ started to financially engineer 20 plus years ago, I thought the JGB was toast. And I think I'll still be right, but it's been 20 years. And what I didn't understand was central banks can keep those balls juggling in the air for way longer. So being right at the wrong time is worth nothing. So anyway, back to the plan. You know, I all my commentary on sectors that are leading, emerging, topping, levels of extension, my plan for the week with all that information. Then I rank all my buy list ideas and then my single best idea. I talk about portfolio, you know, what percent long should max be allowed at this moment? What's my heat if I get stopped out of everything? Performance, you know, then my positions, stop loss, where am I getting out if I'm wrong? And what would signal right or wrong? Where should I add? You know, I have, you know, what would Bill hold? If Bill was actively trading, what would he own right now? So that will keep me on track. What are the top classic TMLs of this cycle? Strategy for the week, max exposure, minimum exposure, other observations, dominant fundamental factor, which is, we could title this whole presentation Federal Reserve easing. And I just want a little commentary. The Fed's mandate is supposed to be price stability, but it is turned into prosperity at any cost. No matter how much we steal from the future, no one is allowed to have pain. If you're suffering, here's a check. Don't worry about being innovative or creative for yourself. Just here's some money. We've got creeping socialism. I don't know when the Fed's mandate changed, but it has changed. If you're suffering, forget helicopter Ben. It's dump truck of trillions. We're about to let loose with another $1.9 trillion. You think Robinhood was active before? Wait till these checks come out. All right, pontificating. Bring me back into line.
Yeah, no problem. We were talking about your ride the wave plan. Was there anything else you want to mention about what you do on the weekends that you think people should know? It sounds extremely thorough, which I think most people don't go to that level, which I think is what attributes to your success. Basically, you're prepared for that week every single week.
I would say I became a broker in December of '87. I got my Series 7. From the daily graphs I subscribed to today, I may have missed my Sunday routine less than this many times, less than a handful. I mean, it's just dedication and consistently doing that ride the wave plan. Now, it didn't used to be called ride the wave plan, but that was something that came along over time.
Right. And sidebar before we talk about your daily routine, I'm curious, what do you think Bill would be owning right now? What are kind of 4 or 5 stocks that you think he'd be really concentrated in?
Be all over Tesla. You know, he was a liquidity junkie. Size mattered for him. I think he might be in APPS. You know, whatever. When I would talk to him, invariably he would be in a stock with triple-digit sales and earnings with a relative strength in the high 90s. He just always was in those. So there's a couple for you. You're catching me off guard right now. I mean, I think he would probably have Roku. You know, he was a liquidity junkie like me. So a lot of the names that I think a lot of people who listen to are on Twitter, they're not precluded from a lot of, they can buy these small names. Size kills performance. Now listen, when I was really early on, I killed it in RIM and Google and Broadcom. I mean, there are amazing, listen, the magic elixir in this world of equities is crazy high sales and earnings with massive liquidity. Just, you have to think like an institution.
Right.
If you're running $4 billion, and which is not that's big, but not huge, you can't buy a $4 billion market cap. So you got to think, where can these guys go? And that's why I dislike IPOs and these lower market cap stocks. There's no or limited institutional support. So average daily true range is all over the place. It's hard to stop your losses at 3, 4, 5, 6% when the thing has an average range of 7% a day.
Right.
I know there'll be stocks that will go from 100 to 400 that I just won't be able to deal with because of the volatility, lack of liquidity. The game is making the most amount of money. Being in a stock that's going to go up 5x doesn't matter a hill of beans if you can't sit in the thing because it's too volatile. Pick stocks that are appropriate for you.
I think that's great. And going back to your daily routine, what do you do from the time that you wake up, check the pre-market futures, if we're gapping down, gapping up, whatever, what are you doing intraday, maybe setting alerts, keeping track of everything? And also, what are you doing after the market closes at 4 p.m. Eastern?
So I probably wake up a couple hours before the open. People aggregate things and send them to me. I review all my positions, but I look at that tape on CNBC and I'm looking for stocks that are gapping massively. Those are big signals to what's, that's new information that's come into the market. I want to focus on those names. That tape is really important. Once the market opens, I want the volume off on CNBC, but in the morning, you can get some great fundamental stories from amazing life-changing investors. So I occasionally will tune in when somebody brilliant comes on. The open, I always want to see what my positions are doing and how it all shakes out. But I always have alerts set on everything. Alerts on the 50-day moving average, 221 day, and then buy points. All the buy points, support and resistance. I have Wanda does that for me. And I try not to trade. Okay. So I'm looking for reasons not to put a trade on. I'm the opposite of most people. I think most people treat the market like a slot machine and put the dime, put the money in the machine, pull the arm, pull the arm. I'm looking to sit on my hands. I want to be forced into an idea, either trimming, adding, cutting, whatever. I have emerged into a position trader where I will trade around a core a little bit.
Right.
I'd like to hedge with options much more. But so 30 minutes into the open, I run a price and volume screen. So I want to see where that volume's going, up and down. So that'll give me clues to new ideas or problems in positions. I'll start reading. And then the close, I absolutely have got to watch the close. I think there's so much conclusive information to come. Say, hypothetically, if I was less impulsive, if I call a trader, say, buy me 200,000 XYZ, most funds go, buy it over the course of the day. The fund manager will call the trader at the end of the day and say, what do we have done? The guy will say, I've got 180,000 of the 200. If the guy really, really wants it and he feels conviction, he'll go fill it by the close. I don't care how hard you run it.
Right.
But if he doesn't do that, he's like, I'm ambivalent about it. We'll get it tomorrow or next week. You see the closing fear of this is a loser. I've got new information that's bad, or I've got to own it.
Right.
The close is where they finish up the buy and sell orders in big, big blocks. That's why volume goes wild.
And I was going to ask you just one question to go. You talked about liquidity and how important that is for you. What, in terms of dollar volume, is kind of your minimum, and what is ideal for you, basically?
It's almost to the point where 150 million is the bare minimum average daily dollar volume I'm looking for. Eve can obviously do a little bit less, but you get to be over 5-6% of the daily volume in something, and there's a problem, you're going to have a hard time getting out.
Right.
But I don't think that helps people. I think what helps people is understanding the dynamic between liquidity and sky high earnings. That's a magic elixir. Everyone wants the magic formula. That's going to be your market leader. The stock, if you had a matrix ratio between excessively high liquidity and sky high earnings, that's where every whale fund is going to have to go. Simply, two stocks, they both have 50% earnings growth. One trades, 400,000 a day, and the other one trades, 3 million a day. The PE ratio on the liquid name will be double the PE ratio on the name with no liquidity, because the big funds are going to crowd in to the liquid name. They can't crowd into the small one. So, you don't ever want to be the big fish in anything, because then you're stuck.
Absolutely.
That's my answer.
No, that's great. pivoting now to market conditions and how you kind of gauge that, what are some key things that you look at that basically tells you what the environment is like and how aggressive you can be at any given time?
Right now, look, I'll just be blunt. If you're not bullish right now, this is the factors surrounding the market are more bullish than I've seen in 30 years. Okay, this makes 1999 look like almost like a bear market. I mean, imagine, look, remember, 1999, the Fed raised rates 3 times. There was no stretching of the rubber band down with the virus panic bear market.
Mm-hmm.
You know, we're in a super cycle. We were in a super cycle before the virus.
Mm-hmm.
The virus just got the Fed to back up a truck of nitroglycerin into the Aggie bonfire. Do you know what the Aggie bonfire is?
No, I don't.
3 stories of telephone poles wound with wire and dumped on gasoline.
Oof.
Okay. Imagine this 3-story high blaze bonfire, just enormous. And then a semi-load of nitroglycerin comes in. That's where we're at. We've got technological innovation in almost every industry. You name it, there's biotechnology, there's drones, there's semiconductors, there's blockchain, autonomous driving, just you name it. We're in an American renaissance of innovation. Earnings, contrary to most people's opinions, are exceptional coming out of this virus.
Mm-hmm.
All these trends that were in place have been ramped and accelerated dramatically. We've got a public who's been stuck in their house for 1 year, who actually has more money now than before, who's dying to get out and blow out and party. We're about to have a roaring 20s. And then you've got the Fed jumping on the accelerator. We're in a super cycle. In this environment, I normally think you get approximately 7% over the 50-day on the Nasdaq, and that's historically where you're getting into excess.
Mm-hmm.
I think we got 14% over at one point last year. And so let's look at the GameStop scenario.
Mm-hmm.
People thought that might get systemic, and the market panicked. We were down like 5 days
mm-hmm.
to the 21-day.
Mm-hmm.
And then whoosh, right back. The market is drowning in quantitative easing. The Fed is probably over torqued this thing. And we have a long way to go, I think. So yeah, I'm ragingly bullish here. We could pull back at any moment, but don't be shocked to see bases not extend. The Fed is so powerful. They've changed the fundamental nature of technical analysis. You cannot expect 7 and 10 week bases. It's basketballs underwater. You ever hold a basketball when you were a kid, or a beach ball underwater? It
Right.
springs up. There's too much money. And stocks will go down on heavy volume because of emotion,
Mm-hmm.
but they're going up on light volume because people are hoarding stocks.
Right.
Lighter volume sends prices higher. So we're in this unique environment where fear drives indexes and price down, and then stocks and everything levitates up because of this quantitative easing. It's global.
Right.
Global central bank printing is the overriding theme of this whole conversation I think we're going to have.
Mm-hmm. Mm-hmm.
How about that?
No, it
Get
makes
me
sense.
back in line, friend.
Yeah. Makes sense. In general, though, for a market not like this, how do earnings reactions and other indicators that you might look at factor into how you view the market? So in a not Fed, completely controlled market, how do you determine those market conditions and whether to really step on the gas or ease off?
It totally sets the pace.
Right.
I mean, I remember many years ago, the market was very bad. And then Amazon came out and the market totally embraced the report, sent the stock up meaningfully on crazy volume. And I was like, that's it. It's on. And I completely changed my tone. I went much longer that day and expanded exposure. Now, if you see a series of bad reports, man, I'm going to really dial back. I mean, right now we're in a little bit of a funny market where the big cap names have been treated kind of lackluster. They're not getting killed,
Right.
but they're not really responding wonderfully. But smaller names like APPS and all these little mid cap or lower mid cap names are responding wonderfully.
Right.
So I think it tells you where to be and where not to be and when to put the hammer down.
Mm-hmm.
I think now is the time to put the hammer down.
Makes sense. And in general, how do you deal with choppy markets? Because in general, They're not the best for trading, position trading. So do you scale back? Do you lower exposure? And when do you get the signal to kind of, all right, now we're trending a little bit more, time to step on the gas?
I handle them poorly. I mean, it's my worst nightmare. It's,
Right.
breakout, stop out, breakout, stop out. And I think what that does is it probably will incline me to open my stops up a little bit and reduce position size to try to catch the wave that's maybe a lot more tepid.
Right.
You just have to reduce your expectations and maybe more do a lot of research as to what is truly unique and what might really participate when we get out of this choppy range. I would so much rather be in a horrible bear market,
Right.
because that's so simple. Clear the decks, go play golf, take the family on a road trip. Choppy markets are just, dude, we are all trend followers. If you follow CANSLIM, you're a trend follower. If the trends chop, you just got to dial it back. So,
Right.
keep a tally. I know my last 3 trades, I've made or lost money. If my sales have gone higher, I know we're in a bull trend. I need to, amp it up. And if I'm in the bear market of 2000, I think I had 13 or 14 losers in a row. I'll never forget this. I was just in this house looking out my back window, horrible bear market. And I'm like, God, if this persists, I'm going to be working at Dunkin' Donuts. I mean, I really felt like it would never end. Here's a clue. When you're in a bear market and you're praying for the weekend so that people can't lose money, you're getting close. When you say things like, I may have to 10 bar, you're near the end of the bear.
Makes sense. And let's see, after major correction, how do you practice progressive exposure to go from kind of tester positions all the way up to now full positions? I know you like 18% is kind of your max,
Yes.
But how do you build up to that level?
Well, on a follow through day, I pretty much force myself, almost no matter what, to buy 3. I used to buy 3, and one time I bought 3 in a row and all 3 didn't work. So now I make it 4.
Right.
But I put them on my first trade. First trade is 10% of the whole account, almost no matter what. If you have less than that, it makes it really hard to trim, because when you trim, you don't have enough left to matter. And 10%, if it doubles, how often do you get a double? A 10% position that doubles only changes your account value by 10%. You want to be up 50% in a year. Think about, you need position size.
Right.
So my opening trade's 10%. Occasionally, if it's a long time to fill the order, I'll pull it back to see if that stock pulls back. I don't want to be the only guy there supporting it. I want I want some big whales bigger than me in there, but I'll fill that order out. If it goes up 0.5%, I'll buy. Listen, I want that whole 18% on, 15 to 18% on. I don't want it to be up more than 1.5% without me having the full thing on, full position. 2% max. There's no excuse for letting it get away from you. Okay. Occasionally you just got to get in. What if it's the one?
Right.
If you're buying it and it's running hard, there's obviously whales in there. Pile in. Now be ready don't do it in the first 30 minutes. That's reversal time. That's Morgan upgrades, Goldman upgrades, the lemmings attack it, they subside, and then it just pulls back all day. If it's an amazing breakaway gap, get some stock on, but pile on all day. And if it doesn't matter if it's up 20% in a day, actually it's a positive. Where does it close? So gap ups on volume on the open is one of the greatest signals you're going to get. And hopefully you're knowledgeable about the story before you start piling into these things. But those have been, I would suggest, 30 or 40% of all my monster trades started that way. Almost every one of them.
Wow. That's huge. When you have that full 18% position, how do you manage that? Because sometimes stuff gets extended from the 50-day, from even the 10-day, even especially in this market. So if that pulls back, it's going to pull back hard. How do you deal with the emotions of that? Do you put some hedges on using selling calls or something like that? Yeah, basically, how do you control that? So you want to let it fall all the way back to the 50-day because that's your guardrail. But how do you manage that position in that kind of in-between space?
I used to say you have to have a total disregard for money. If you care too much about what you can do with it, you're going to be fearful and panic. You won't be able to take the drawdowns. I used to not even trim. I just was all in and I just rode the crazy volatility. And even on margin, and my equity curve swings were enormous back in the day. Then I started to trim a little bit when it was, I look for the level of extension that it's historically been engaging in. Now, in a market like this, you have to add, where you've got to understand the temperature of the market. So now you have to assume extensions are going to be expanding, but when they get, if Roku is 35%, 40%, 38% extended, that's about where it's peaked out recently. So I think one more day up here, and you need to sell calls around the 21-day, maybe the 50-day, depending on where the general market is too. You've got to factor all these things in. I used to trade more. First of all, I never used to do anything. I just wrote them because I didn't care. I cared, but I didn't care that much. Then I said, I'm getting too old for this insane volatility. I'll trim. And I realized I wasn't trimming enough to endure that whole pullback all the way down. And then I didn't like paying the taxes and dislodging these great names. So now I'm into selling deep in the money calls and getting that extra premium, the volatility premium, the time premium working for me. So that's how I do it. But the bottom line is, if you're counting up that 50 grand, 100 grand, or whatever it is, 10 grand, as I could take my family on vacation, or this is what I could do with it, you're doomed. You're cooked. You will act defensively. You will not trade in line with the potential of the position. You'll act out of fear.
Makes sense. And just so we're clear, what is your definition of extended, both for a stock position as well as the general market?
It ebbs and flows with the enthusiasm of the general market. It's you got to take the temperature of the market. On an average, 7% on the Nasdaq is extended, but in certain occurrences after a bear market, it can go 14. It can even go as much as 20% in a while. 22%, I think, is maybe the greatest extension ever in Nasdaq. But sometimes it's 5%. If you're in a dull market, so look, it's understanding the nature of the position you're in. Is it some tiny little piece of crap that can go 100% over the 50-day, or is it Costco that can't get 8% over? It's just the nature of the beast. Know your securities. Know its personality. Markets have personalities. Stocks have personalities.
Makes sense.
We have personalities.
Makes sense. All right. So now I want to talk a little bit about stock selection because people had a lot of questions about that. So first, in general, how do you find stocks to trade, and what is kind of your overall screening process?
My number one is relative strength. I sort out my whole watch list by RS. So I'm looking at, it's gotten to the point where I get halfway through it and I'm like, what am I even looking at this stuff for? It's crap. You really want to focus on the leaders, and then volume percentage change up 30 minutes in is that's the gold. I mean, you're mining for gold by screening. That's like panning in a river. I screen for highest up to down volume during the weekend. I screen for leading relative strength in down markets. That is really, like, bear markets are a huge opportunity. Do not fear them. Don't get distraught. The sun will rise. And if you know what the leading RS is, you're most likely to be in the leader before everybody else. And you'll occasionally get a leader poke its head out before the follow through day. Now you're really onto something. In the 2000 bear, E-Research, ERES, it might have broken out a week or two before the bottom, before the follow through day. And that thing was just unrelenting. So screening, leading RS, up to down volume, screen for earnings surprise, screen for, look at the new high list every day as much as possible. This takes time. If you're going to look at the whole universe of stocks, then every index, then every commodity, then start screening, you're in for 4 hours on Sunday.
Right. But that's what it takes.
Yeah. And it's worth it.
Right.
Really, you want to get rich? Put 4 hours in on Sunday.
Right. Exactly. And what do you look for in a potential position, both fundamentally and also technically?
I'm looking for walls of blue, would be multiple weeks in a row of up, and then skyscrapers, like Trump Towers of one-story houses, and lots of them. Almost every single monster has it, unless it's something obscure that no one's covering, and then they come out with news, and then it has its first explosive move, and that's your first bar. But there's always signals, not always, almost always signals ahead of the curve, ahead of the blowout, the big move up. So walls of blue, skyscrapers, and then kind of like regressive patterns or ascending patterns where it's trying to base, but then it has another quick leg up. That's basketball underwater. It just can't stay down. Right. Those institutions are like, normally they like to sit on the bid and just soak it up. But when they're not getting stock in, they go raise the bid. And, and then all of a sudden the floor's higher. So I look for that. I'm not as good at identifying those or having the balls to, to really get in there. So I look for all those things. Leading RS. It's just pointing you right to the name.
Absolutely.
Sector. You have to do a sector analysis. What's risen 15, 20, 30, points in a week. Always, you want the wind in your sails. So get in those top sectors. They will vacillate from 1 to 15 or 20 and then back up again. They're not going to stay number one forever. If you want to be in a monster, you have to be willing to watch that sector go out of favor in short term, intermediate term, and then come back.
Makes sense. And once you've got a name that you're interested in, what fundamentally are you looking to learn about the story behind the company?
How big's the market? How big might the market get? Where is it now? Are they the true leader? Why do they have an edge? What's better about their product? I remember talking to David Ryan. I was pitching him when I was a retail stockbroker, and he calls me. I was like, "Yeah, what do these guys have that's different?" That was like the first question he asked me. What do these guys have? Is it patent protected? Who's the competition? But the fundamentals have to be corroborated by the technicals.
Right.
I usually find a stock because of technicals. Something unusual is happening. Like I'll email Eve. I'm like, what's going on with this thing? That, the market just fell 8% and it's up 2 points over the same period of time. There's unusual strength being exhibited. Right. You're looking for unusual strength. And that's the leading RS. That's the new high. I'm off track. What did you ask me?
I asked you about the fundamental research. What do you look for in a company once you're interested, once you notice that the chart is special?
I want the fundamentals. I want to be reflected in the fundamental variables: pre-tax margins, after-tax margins, return on equity, sales growth, earnings estimates, earnings beat, all ideally over 20, 30%. You start screening like that, and you're going to narrow your universe down to 10, 15, 20 names.
Right.
Those are the only ones to be interested in.
Right.
I mean, that's a little bit of an exaggeration. Relative strength is the dominant factor, and a lot of, I would say 30, 40% of the biggest leaders in the market have not had earnings. We're in a cycle right now where you can, listen, they got Webvan IPO'd in 99, which was the biggest piece of shit. I mean, look, IPOs in bear markets that can come out, almost every single one has earnings. Okay, only the very best quality can come out in bears. Major signal. Acacia, I think, came out in a bear.
Mhm.
Google, I don't know about Google, but when you get IPOs in a hot market, there's probably like stinky fish crated up with nice wrapping paper around it. It's crap. People will buy anything in a bull market.
Right, right. And are you interested at all in what funds are in the stocks that you're looking at? And also, what are your thoughts on ARK as well? ARK Invest.
ARK Invest is, Catherine Wood is doing some of the whole team are brilliant, brilliant, brilliant. What funds are in there is critically important to me, massively underrated as a variable. But I do want to go into something. I've been doing this since 87. When I got in the business, Robert Prechter had called the crash. Elaine Garzarelli had called the crash. They were the Pied Pipers of that market. The market stood on every word.
Mm-hmm.
You guys don't know who they are. Then came Garrett Von Wagner and the Jacob Internet Fund. There was George Gilder, was the Pied Piper of that 98 through 2000 internet bull run. Brilliant, brilliant man. Now he's written a book called The Life After Google. He calls it the Cryptocosm. He called the Telecosm. He coined that phrase for the bull market in 98 through 2000. Catherine Wood all these people were fairly smart to brilliant, but they had their moment.
Right.
They ultimately all were goats. Not the greatest of all time. I mean, the smelly goat. Mm-hmm. Initially, so they're having their moment right now. Catherine, and it's got nothing to do with how she's doing amazing work, but it's her moment.
Right.
It will not be her moment down the road. Okay. When the bubble bursts, there will be another Joe Granville, another Robert Prechter, another Elaine Garzarelli, another Kathleen Wood. Pay close attention to the performance of these funds. When ARK's bubble pops, the whole market's going to pop. Mm-hmm. So again, I'm way off base. I think she's amazing. I follow her. Tom Lee, the man's been correct. And it's not beneath me to ride their waves. I mean, I read their research, okay? Mm-hmm. I am a knockoff artist. I copied Bill O'Neill. I copy anybody successful. I don't want to invent anything. The Japanese had it right. Just find somebody who's figured it out. If you can improve that much, look, if you found somebody who was a billionaire and they wrote 3 books on it and gave ad nauseum speeches on how to do it, what more do you need? If you're half as good as 500 million, gonna just get you by?
Makes sense. Makes sense. I was also asking you about the top funds that you like to see in stocks that you're interested. So I don't know if you look on Wanda and look what funds are in it. But yeah, how much does that matter to you?
If I don't have one of the top funds in there, I may not buy it.
So it's big. It's big. It's
very big. I mean, you'll find oddly, Luckin Coffee, almost none. Mm-hmm. Not one of the top funds. Mm-hmm. The biggest brokerage firms, prime brokers, were not in Bernie Madoff's fund. Mm-hmm. They figured it out. It was the most well-known secret going. Institutions are smart. You don't get entrusted with $50 billion because you're dumb. They're doing the research. I mean, we're just piggybacking these guys if you're a trend follower.
Right.
So I want those guys in there. And, when one guy lets rip with 500,000 shares and they want out and Fidelity sees it, like, yeah, we'll take it all. But if they're not there and that 500,000 comes on, it's going down and it's going to be wicked.
Right.
Institutional support smooths volatility. Mm-hmm. I want to make this easy. I don't want to be jerked around all day.
Makes sense. Makes sense. I think I already know the answer to this question, but I'll ask it anyway. What are your thoughts on just kind of pure story stocks? So like JMIA Technologies, JMIA, which is the Amazon of Africa and all of that, but it's got no fundamentals at all, no earnings growth, no sales, nothing. But its price action is superb. It's fantastic. What are your thoughts on those type of stocks, which are kind of pure momentum plays?
Look, I've seen this cycle many times. When froth and speculation really starts to percolate, it's just a game of when the music stops.
Right.
Okay. It's kind of like the short squeeze we had over the top 5 names, Bed Bath & Beyond, GameStop, Cost, all that crap.
Right.
That wasn't investing. That was musical chairs. By the way, the music stopped. Okay. These SPACs, some of these SPACs are going to be wonderful. Most will not. Just get a list of the IPOs that came out in 1999. All right. You tell me how many are left.
Right.
We're saying when this heats up and it gets even more heated up, it's going to be pure technical, not fundamental. You're going to have to gauge the psychology and the temperature of the market. Otherwise, you're going over the top and you're going to get destroyed. This will end like all other bulls, just like GameStop ended, just like there's nothing new in the stock market. Read Reminiscences of a Stock Operator. It's the Bible. Well, it's one of the Bibles.
Right.
It's going to end terribly bad. How about that? With JMIA, JIMA, whatever that is, I've seen it. I don't own it. No earnings, small float, low liquidity. It's a game.
Right. Makes sense.
But you can make a lot of money in the short pull.
Absolutely. I wanted to ask you about valuation metrics. So price over earnings, price over sales, what you think about those. And if you don't use them at all, which I think is likely, what do you kind of look at to say this stock has gone too far, even if it sets up again, I'm not really interested in it?
I look at PE so contrarily. If it doesn't have a big PE, I don't want in. There's nothing unique happening. I use it as a measure of risk. If they miss earnings and the PE is inflated, I know I'm in for a pounding. It's a measure of risk for me. People who use PE to buy stocks on valuation are inevitably, by default, going to miss every explosive game changer.
Right.
I almost don't look at it. If I do look at it, it better be big. And like the odds of me uncovering something before all of the brightest analysts in the world is about 0. Like I know I'm not going to do that. And if I do, I know there's something wrong. I'm wrong. I want that PE to be big.
Right. Makes sense. And what about price over sales?
I don't even look at it. It's not a variable. The top 100 stocks in history, it's not a variable in the key winners. It just doesn't matter. Modern portfolio theory, asset allocation, all this crap they teach in college. Like my daughter's going to graduate and they're jamming her head with all this worthless crap. It's got nothing to do with making money. And price to sales is one of them. I want to know what made stocks go to Mars. Certainly not price to sales.
And so what do you look for in terms of price and volume then to say that a stock's run is over?
Well, climax run is just an app. But here's the thing. Tesla's had 3 of them, I think.
Yeah.
We're in such let's put it in perspective. In my life, 30 years, I've never seen 3 climax runs in one stock. Now we're starting to see them more frequently. It's just a sign of the level of uber bullishness that's running rampant on Wall Street right now. It's a signal. This is a time to be bullish. I'm not saying we can't pull back short term, but these climax runs we're seeing are unusual. I remember in the very end of 2000, I think I counted like 13 climaxes in the last week, of which I owned many of. And I knew just because of that we were done. I thought I knew, and I sold into all of them. And that, I have a lot of shortcomings. If we don't have a climax run, I'm going over the top. Like I'm going to sell way off the high. I just happen to be pretty good at identifying climaxes. Short squeezes are one of my favorites. Climax runs are a great signal. I look for those. And listen, after that, it's breaking the 50. How does it break the 50? Is it violent? Is it a subtle descent to the 50? Is it glancing, or is it just going straight down, the velocity coming in?
Right.
So, you know how rare climax runs are? You normally get 1 or 2 in a year. Now it's like weekly.
Right. Right.
Okay, that's giving you an idea of the environment we're in here.
Absolutely.
We're not going to see, listen, when this ends, we won't see this again for 10, 20 years.
Mm-hmm. Mm-hmm.
So this is a rare moment in time.
Very cool. Okay, so talking about entry setups now, you say that 30 to 40% of your biggest winners start with a huge gap up on volume. So take me into your mindset on a day like that, knowing that there's a gap coming in pre-market. What do you look for in terms of the volume run rate compared to the average 50, and also when do you buy during that day or add to your existing position, and how do you define risk? Because something that's already up 20%, it seems very easy that it can pull back 3%, stop you out, and then just make a U-turn and keep going. So talk me through earnings gap up, how you approach it, and your entry signals.
I will start in pre-market, but I won't start big.
Mm-hmm.
A gap up is different. I won't just start with 10%. It's
Mm-hmm.
too risky.
Right.
But I will build, and I mean I'll build all day. I'll buy 5% for first trade, maybe 3, 4, 5. Market opens. If it's up 10 minutes in, I'll buy some more. After 45 minutes, it's not going down. Now I know that this is real demand here, and I'll buy more. I mean, I think when Sandisk exploded out, this is in like 2003, I might have bought it 7 times that day.
Mm-hmm.
And it closed almost at the dead high. I open up my risk parameter. I don't like the gap low as a stop. I might use it if it closes in the lower half of the pattern or low in the pattern. I might dump half at the end of the day, but you kind of have to say, this is a unique opportunity. I'm going to expand my risk here. I'm willing to take a 6-7% loss in the possibility of asymmetric 300% upside.
Right.
These are in the volume percentage gain based on market cap. Okay, if you have a $100 billion market cap, a 400% increase run rate is gigantic. To turn the float in a monster, you have to accept lower percentage gains, but still enormous. In a smaller, like I think the day I bought Sandisk, it might have been 2,300% over normal daily volume.
Mm-hmm.
I mean, they invented the memory stick for digital photography, and that was an evolution in photography. It changed the world of photography. It was an explosion. Amgen back in the day, they invented the red blood cell replenisher, which allowed you to get heavy doses of radiation and chemo or fight AIDS. They earned 32 cents against a penny, and the stock went to Pluto.
Right.
It was one of the greatest explosions in volume anyone's ever seen. So you got to correlate to the fundamental discovery of new information with the volume, with the price action all day. Is it trading higher, 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 and stay with it and be ready to get stopped out? Like in this market, we're seeing crazy gaps every day.
Mm-hmm.
Make sure it's a real company. There's fundamentals there, that it's not deep effing value saying, let's buy silver. Okay. That was pretty simple that wasn't going to work after it had worked in 15 names in a row.
Right. And how do you differentiate between a gap like we saw with Pinterest, where it's coming out of its first kind of long-term primary base, versus something that's already made a move and it's maybe a 3rd stage base, 4th stage base?
An exhaustion gap is very different than an initial gap.
Right.
I actually will buy a stock out of a terrible base if like Genentech came out of a horrific base. Genentech's not even trading anymore, but it came out of this choppy pattern on wacko insane volume, and you just had to get in there.
Right.
Okay. Now, when you have multiple extended bases and you're deep into a bull run, I mean years, you want to be cautious of these later stage explosive moves out. They're exhaustion gaps after many, you just kind of gave me the definition of an exhaustion gap.
Right.
Okay. And listen, when these things reverse, they reverse.
Mm-hmm.
I had a stock called some Chicago consulting company, Hart Whitman Hart, or whatever it was, they get a takeover announcement. I'm in it up to my eyeballs. It gaps up 45 points. 20 minutes later, it's up 20. Next thing you know, it's down 8 points. Okay, it might have closed down 20 points that day. When they do that, forget about, I'm going to wait.
Right.
Dump it.
Right.
Dump them. When you see a climax run, 8, 9, 10 days in a row up, or 12 out of 15 days, especially after an extended run, and then it reverses after the biggest run, biggest gap up ever, you can't sell fast enough. Like it might be down 20. That stock could be down 50% in a week. It might be down 20% in 2 days. Sell and run for the hills. Forget about, I'll just wait for it to go up 4 or 5 points. Just get out. That's a hallmark of the top.
Gotcha. And what are you hoping to see after the earnings gap up day? What would kind of tell you that institutions aren't done buying and that there's follow-on demand?
If it's a smaller name, I want it to get ignored, but I don't want it to come down at all. I want it to go in a dead tight line.
Right.
And the second, if that happens and it goes 4, 5, 6 days, trading days, not, and then if it's really tight and it hops out, I used to double my position. I don't do that anymore, but I will always add on that. And I will very frequently add off of very small digestions when I've got a monster position on. I'm just trying to get the most money in these names. Like, I will add to Etsy or Twilio. It's not a legit buy point. Starting a brand new position off of a little digestion is suicide. But I'm also I'm adding such a small amount that if it pulls back, I'm not going to sell that stock. It won't affect my overall cost basis. And I'm just bulking up in these big leaders that I think can go way higher.
Right.
So I will nitpick away at these things, even though I might have a lot of stock. I'll just go buy 5,000 more. I'll just, you want all your money in the biggest winner, and you want it there at the right time. Being early, not good. So,
and what's happening behind the scenes during very tight action? Could you kind of explain what's going on with the supply and demand characteristics there?
No sellers, number one. And there's probably people are going, wow, what just happened that sent that thing up 20% on volume? They're doing their research. They're scrambling to figure out what's going on. And then you've got the guys who know they're on the bid and they get so aggressive they can't wait anymore. And they just go, they call the trade, like, take the offer out and go. It's just a fundamental understanding is occurring, which won't let it go down. And there's a lack of sellers, there's no sellers hardly. And then the whales just drive it higher. Look at John Boyk's book. There's a couple examples in there of Enzo Biochem was one for me. They're all in there.
Yeah, I highly recommend his books. I love them, especially the Legendary Traders, going back to ages. It was awesome. I want to ask you this: when you're looking to initiate a position, what time frames are you toggling in between the moment that you're trying to buy stock right then and there?
Bill O'Neill loved the weeklies. When I'm putting positions on, I'm looking at the daily. I have a ton of intraday charts on my screens, and I find them to be much more distracting and make me do stupid things than help me. But occasionally I'll see patterns in there, or I'll recognize it's going through an intraday high, and it'll help me. And it also signals for me, the intraday chart, weakness amongst everything. Like Etsy was down for me today. It was just dead. I think volume was 50% below normal. So I don't sweat it, but it just, like, CrowdStrike was lagging all last week. It was always the stock that was down the most in my portfolio. When a stock's emerging, I'm mostly looking for higher all day and a steady stream of heavy volume. If the volume doesn't back off, now Guggenheim's in there, some monsters piling, more than one monster. So I'm looking for steady volume all day, and ideally you want that high close.
Absolutely. And switching over to position management, a lot of people had questions about this. And we covered a little bit already dealing with extended stocks while you sell the deep in the money calls. But I do want to ask you, if you're in something that you deem a true market leader, and it's not really working, other stuff is working in the market, how do you deal with FOMO? And do you ever sell something if it's just kind of going dead sideways and it's kind of dead money while the rest of the market is continuing higher?
No. You want to be in there for that, like Roku. Today, the thing was up 50 points at one point, but you had to sit. Listen, you can't be in a stock for a year or 9 months and not have Gandhi days. Gandhi was a peace-loving, religious man of good nature and giving. He yelled at a guy over a counter one time, like, like he wasn't perfect every day. Mother Teresa has bad days. Stocks have bad days. You cannot dislodge monsters. When you know the fundamentals, why would you sell it? It's just institutions are elsewhere that day. They can't be on the bid every single day for a year. They're going to pull back, and patience is how you get a 300% gainer in a mid-cap stock. In a year, how many Gandhi days are you going to have? There's going to be a lot of them. There's going to be stock lockups. If you're in these newer names, there's going to be, lockups on a stock I had, Broadcom, one of my first monsters. It fell 38%. Well, the general market was in a blow off, and I sat through the whole thing because I knew the fundamentals. It was a lockup. I wasn't dislodging that thing. It never broke the 50. I don't want to. I need to be forced out. I'm never preemptively selling unless it's a climax. I have to be forced out on information. I'm not getting rid of my monsters. I worked so hard to get into it. You know the value of a cushion? It's a game changer for your mental state, you don't have to be anxious. If you're in and out all the time, you're on a razor's edge of, I'm going to get stopped out. I'm going to get stopped out. If you are up 30, 40, 50%, let it pull back. Who cares? You want to make this as easy on yourself as possible. If you do that, you're going to have to chill. FOMO kills performance because you're going to get stopped out. Buying extended is a rookie move. It's a rookie move. It just is. I mean, there's buying extended and there's buying gaps. After a stock is persistently run up, you're just asking to get kicked in the face. I mean, you only have to touch the burner so many times before you stop doing that.
Makes sense. And you said you don't want to sell your position at all if you deem it a true market leader. What makes you do the opposite? What makes you buy? What are your basically add-on buy points that you'd like to go to?
Like I said, 5 days tight, just dead action, and then it hops out. Or like in this market, you're just not seeing long bases. Now I have my positions on, and I'm not screwing around with them. I'll just put a few shares on, I'll just, add. And I haven't had many shakeout moments. This market is crazy strong.
Yeah, absolutely.
And listen, if you're hedging into levels of great extension, it really makes the pullback easier. Now, clearly, like I shorted calls on half my canopy growth, a little bit less than half. And today the thing blew out through the upside. I'm willing to accept that. Okay. I still have over half my position unhedged, but if it pulls back later this week, and it even pulled back later in the day today, dampening volatility coupled with deeply understanding fundamentals is going to keep you in these names. And that's the secret to getting rich.
Right.
Okay. Short-term trading does not scale. All right. Just get used to it now. Build your war chest up in these little monkey names. But when you start to get serious, you need to learn how to sit. Hedging, understanding fundamentals, experience with patience, knowing you need to sit through 4 quarters of beat and raise quarters. Okay. That's how you want to change your life. You get 4 stocks in your life that have 5, 6 beat and raise quarters and you're positioned right. Game on, man. You're rocking.
Right, right. When a TML does end up basing, what, based on the price and volume characteristics, are you looking for within that base that tell you it's under subtle accumulation and is likely to continue the trend once the general market lifts, whatever's causing that base?
If you look back, Tesla had this period of just excessive tightness and volume dry up. It was just beautiful. Google did it.
Yeah.
You can go, a guy named Lee Freestone taught me dissect day by day by day, week by week by week. And you'll just see the close, the dry up in volume, the spike up on, it's all color coded for you. Just go day by day, week by week. Now, the thing is, a lot of monsters go dormant while the general market goes, and that causes relative strength to go down. And that's where I kind of screwed up with Teladoc because it broke out and I'm like, the relative strength sucks. And I let it go. And now the relative strength is ripping and it's now extended. I could be tempted to have FOMO and go buy it. And it's probably going to be a mistake. So the point I'm trying to make is when you have a wonderful stock go dormant while the rest of the market goes up, RS is going to weaken. And it's now a fundamental call. How well do you understand that story? And do you think it's got a second leg? So you have to assess. Listen, this all boils down to fundamentals. What do you do? How well do you know the story? Are you going to gamble with an 80 relative strength or 76 relative strength on a breakout? You better damn well know exactly what's going on there. Okay. You're not going to, I don't take shots. Okay. I'm not at the racetrack. I'm not in a casino. I'm here to make it.
Right.
Okay? I want the odds. I'm the house here. The odds are with me. When you have 40 variables and they're all lined up, the odds are, I could be wrong, but I'm not going to be wrong 40 in a row. I'm going to be right more than I'm not.
Right. Right.
That's the base and the volume price action. When they get extended in a bull market, the RS could be lower. And that's what I'm trying to convey.
Gotcha. And shifting over to portfolio management, because as a trader, as a position trader, managing your own fund, especially, you have to be your own trader. You have to be your own risk manager, portfolio manager. What do you think are some key concepts when it comes to managing an overall portfolio, whether it's distributing over many different leadership groups or make sure you're just not overly concentrated in one? What are some key concepts that you think people should know when it comes to overall portfolio management?
Number one, I don't get tangled up in too many names. I think I'm running 7 right now. I'm 130% long. I'm not trying to watch everything. I'm watching my basket of stocks. I do overlap a lot. And even though Tesla is an auto manufacturer and Roku is an cord cutting play, when one breaks, the other is going to, even though you're diversified by sector, the leaders break together.
Right.
So it's kind of like over correlation in monsters, leaders. TMLs tend to run together. Now FCX may go counter because it's a completely different industry. But don't own too many names. Don't watch too many things. Okay. Watch them on the weekend to see what might be maturing and topping or in its infancy and turning up. But when the market's open, you focus on your little basket. Listen, you get over 15 stocks, you're pinned to the index. You're beholden. You're beholden with 5 names, 6 names, but at least you're not going to pick 15 stocks that are going to double or triple. If you pick 7, you probably get 2, maybe, if you're using the finest criteria.
Right.
You start to over diversify, you're doomed to mediocrity. So don't over diversify. It's kind of hard watching crypto over here and then all this over here. I've got my hands full, man.
Yeah, I actually just wanted to talk to you about crypto. So I'm very uneducated when it comes to crypto. So I guess just break it down. What do you think the vision is for cryptocurrency and what do you think people should know basically if they don't know anything at all?
blockchain technology is the internet 3.0. I was there when Netscape came public. I was in the deal.
Mm-hmm.
I watched the whole build out from the infrastructure to the destruction of bricks and mortar to the untapped uses of the internet. I watched the whole build out over 20 years.
Mm-hmm.
We're seeing it all over again, except it's occurring at a faster rate with better solutions. How old are you?
23.
Okay. You have Venmo.
Mm-hmm.
Chase Quick Pay.
I don't have that.
Okay. But listen, people your age are totally open to digital payment.
Yeah, absolutely.
Totally good with that. I'm 56. People my age and older are like, Ledger wallet, crypto, tons of paperwork to open up an account. Robinhood opened 3 million accounts last month.
Mm-hmm.
3 million. Okay. Charles Schwab opened 75,000. Young people are totally open to crypto. Young people don't trust banks. They watched the destruction of wealth through housing and their families in 08, 09.
Mm-hmm.
Kids are sick of censorship. Adults are sick of censorship on Twitter, Facebook. Crypto takes the power out of a bank or an institution or the government, and it puts it in the hands of the people.
Mm-hmm.
Facebook is not free. Facebook is scamming everybody. Mm-hmm. Facebook is going to have to reinvent themselves, because as soon as I can put my content up and the ads sold around my social media, I get the revenue. Facebook's done. Censorship over with. Rigged elections. The best election software is blockchain technology. Blockchain is quicker, faster. The adoption rate. Listen, cryptocurrency is Bill O'Neill 101. Institutional adoption.
Mm-hmm.
A whale of all whales blessed it with
Mm-hmm.
Elon Musk. But the titans, the maverick titans, Paul Tudor Jones, Stan Drunkenmiller, Bill Miller, they're all in. Principals, Ray Dalio,
mm-hmm.
the old men, older than me, who are running these thunderous pension funds, they're not there yet. This is so early, but it's going to build out just like the internet did. We're going to have many cycles of extreme boom and bust. Yahoo used to be a public company, and in some cycles they called it boohoo because it got crushed. As crypto will have these cycles, but just wait till these Robin Hooders get their next stimulus check. They're not going anywhere. They got a taste. They're going into altcoins. This is so far from the top. The second most good housekeeping seal of approval token, Ethereum, there's hardly any internet searches for it on Google. They're all looking at Bitcoin. Ethereum has thousands of uses in decentralized finance. It has amazing utility. Polkadot has real value. These protocols are going to be here for a long time. All these shit coins and stuff, these Robin Hooders are going to attack that. Now, when you start to see that stuff rip, we could be getting closer to the end of this cycle. But don't be shocked at all if Bitcoin's 100,000. Mm-hmm. Not for 1 second. That's well within the cards. If we start to see public companies' treasuries start to just allocate small amounts to Bitcoin, mm-hmm. I mean, the halvening just occurred. We are in the supply-demand squeeze of all squeezes. The rewards, the miners were dumping their rewards, which was keeping the price down. Well, that was cut in half. You couple that with PayPal exposing 300 million people to buying crypto with a click.
Right.
That consumes more than all the daily supply by miners every day.
Mm-hmm.
Now you throw in these institutions. This is institutional adoption 101, Bill O'Neill, all over again. I mean, it's just a better mousetrap. It solves the problems of so many things. Censorship, rigged elections, banks ripping you off, power to the people. It's just wildly superior.
Makes sense. And for people who don't know, what is blockchain technology?
It's like a ledger, like an accounting ledger, and every block is predicated on the security of the prior block, and it's all secured through cryptographic technology. This is really a deep subject, but quite simply, it is a immutable, trusted, secure protocol, which can be used for the utility of it. It's so many uses. It just solves so many problems. It reduces friction. It takes the exchange out of things, like a smart contract, which is on Ethereum. If I want to have a bet with you, you and I bet $1 million on the S&P goes up 8 points in 3 days. There's no broker in between. It's just a smart contract. If it goes up, it pays you the 100 grand. It takes the brokers out of it. It's a perfect ledger for accounting. It has so many uses. It's unbelievable. And Bitcoin is a one-trick pony. It has one use. Okay, it's store of value. Transfer a payment, it's okay, but Ethereum has thousands and thousands of utilities. Expect Ethereum to grossly outperform Bitcoin before this is over. And then after that, the altcoins are going to go crazy. That'll be the speculative frenzy. That'll be the psychology, knowing it's getting too heated up, that experience brings. But all this will happen. Makes sense. And so you already mentioned Ethereum and Bitcoin. What are the true market leaders of the crypto space? Right now, it's Bitcoin. I actually jumped the gun. Ethereum started to relatively outperform Bitcoin, and I started shifting into it. And then Elon wrecked my wagon. So you've had a moment where Bitcoin has reclaimed RS, but then you have Polkadot. There's going to be a few ICOs coming up here that are going to be amazing. Definity, Filecoin's amazing, Maker. Just look at the top market caps right now, okay? And run the relative strength against Bitcoin, and you'll see the clear leaders. But you don't have to get fancy here to get rich. Right. Okay. Imagine if you bought, I used to say if you bought 1/1,000,000th of the, when I was pitching people on the crypto fund, I'd say, put $500,000 in. What if you bought $500,000 worth of the internet in 1989, 1990? You'd be a multi-billionaire. Now, crypto's blowing up, and you can't really do that anymore with $500,000. Now, $500,000 might be 1/10,000,000th of it. But we're looking at the greatest asymmetric trade I've seen, in second or biggest in my life. You put that money in, and if you lose 30 or 40%, that sucks. But if someone would say you could lose 30 or 40%, but make 10x or 50x, I'll take that all day, every day. And that's what we're looking at. This is going to take time. There'll be many cycles, but this is a bonanza. We're looking at hyper growth here. Okay. And the tokens are not acting like stocks. This is a gold rush. Price is scrambling to identify value and utility. So we're going to have probably a couple cycles of this hyper growth as things 5 years from now are more understood of what is more of a real utility token, has value. They'll start to trade more like stocks. But right now, it's an absolute gold rush. Price doesn't know outcome. It's trying to figure that out. And that's where you get these wacko moves right now. And this is going to persist. This is the biggest opportunity in my life. Now, I might be wrong, and I'm willing to lose some money on it, but trend is proving me right now. Expect radically higher prices with volatility. Remember, Bitcoin had 7 or 9 30+% corrections in the prior bull run. Expect nothing less. It is a little bit more mature, so do expect as many corrections, maybe not quite as deep. It's that much more mature, but it's not easy. This is going to be tough, but it'll be so enriching. Makes sense. And how do you handle that volatility? How would you build a position in crypto if you got none right now? How would you build a position up? Crypto charts so beautifully. It respects technical analysis wonderfully, just as you would a base. Ether had one of the greatest bases I've ever seen, I think at $50 back in 16 or 17. You'll see that again. Look at Polkadot. I mean, these names, they respect technical analysis so well. So I would really just look for digestions and buy breakouts. in relatively strong tokens and do the research, understand what these tokens do. Don't just go buy crap. I suppose if you're a cowboy, you could allocate 10, 20% of your money to junk coins in hopes that we're going to have a speculative blow off and they might go 10x each, which is very plausible, but that's not I'm building my hedge fund out to have the utility tokens for the next 5, 10 years. Now I will trade them and trim them heavily at feverish moments.
Right.
So I'm building this fund for 10, 20 years. Like I'm in it to win it. I think this is a major opportunity.
Makes sense. And what do you usually actually buy the crypto on? What kind of service or platform?
I have a institutional crypto broker that most people are never going to have, but I do use I have used Uniswap. I use Kraken. I have Binance. I have all the big exchanges that, the DeFi exchanges. Listen, there is a great place to start for the guy who's just coming in. These decentralized exchanges are the future. Okay. CME, look out. I would start there, but listen, Kraken's great. Binance is great. It's a pain to do the paperwork. Get it done.
Makes sense. And I guess that's most of the questions. I'm very unfamiliar with crypto, so I don't know exactly what to ask you. So I guess I'll ask you this. What else that we haven't covered do you think people should know, or what path do you think you should set people on to educate themselves about crypto?
I'd read George Gilder's book, Life After Google. I mean, first of all, you have to understand, take advice from people who've kicked ass all over the place.
Right.
George Gilder is the Mac Daddy of technology. He's one of the most brilliant men on the planet. He deeply understands crypto. Read the book, Life After Google. He coined the phrase, the cryptocosm. He coined the phrase, the telecosm. He was the Pied Piper of the internet boom. This guy is brilliant. Read it twice. That'll give you an idea of the possibilities. Thomas Lee, Cathie Wood. Okay, it's not beneath me to follow these guys. They're brilliant. Follow them.
Right.
Crypto is a world of brilliant technologists who couldn't trade their way out of a paper bag, and brilliant hedge fund managers who don't know shit about the protocol, but they can smell a bull market when they see it. I'm looking at this as a quasi technical fundamental, just as I do in equities. I'm applying the same principles. Always follow the trend. It'll get you there. Don't get overly drunk on the possibilities if it turns over, but stay with that trend. And this is a wild bull trend.
Absolutely. Awesome. So I guess I kind of want to wrap things up with it. Oh, go ahead.
Need to follow Sam Sherwinski on Twitter, Mason Jepp on Twitter, Blockware Mining, Blockware Solutions. These are the cryptocurrency leading rig brokers in the United States. Sign up for Growth Stock Mentor. I'm going to go backwards. One massively misunderstood tool in this market is the VIX.
Right.
The VIX gives so many clues. When the fear came into the market on this short squeeze panic, when the VIX broke, when it popped that fear, I knew to unwind my hedges. And the more it popped, I think it hit 30 something and it came down to 25 in like a day.
Right.
The fear bubble popped right there. So I was unwinding hedges rapidly. The VIX has grown as a tool. It's one of my number one tools. So that was just out of the blue.
No, it makes sense. And actually, I wanted to ask you one more question out of the blue because I forgot to ask you this. In terms of fund ownership, what is kind of a sweet spot in number of funds in a stock, do you think, to start that first position?
It's more percentage of the float.
Gotcha.
The more funds, the better, but you don't want them over 30, 40% of the whole float. That's over ownership. It doesn't mean I won't buy it if it's that high, but every once in a while you get a Cisco where it has 14 bases. They're rare anomalies, but they're these waves, these tidal waves, and you just have to go with them. And I'd say if you do get deep, overly institutionally followed, it's going to be more of a muted, understood name. It's not going to have the horsepower. But if you understand that story and it breaks out, know your risk.
Mhm.
Every time you lose a variable of the 20, 30, 40 in CANSLIM, your risk rises.
Right.
You want to buy a stock that's missing 4 or 5 variables, your risk is 80% you're going to get stopped out.
Yeah, no, that makes sense. Awesome. So to wrap things up, I think it would be very cool to have you walk through a historical monster stock. So yeah, I'm excited about this. So if you could tell us, how did you find it? First of all, what made you buy it? How did you manage it? And then ultimately sell it? I think that'd be an awesome way to wrap this up.
So when it came public, can you see my arrow?
Yep.
Okay. When it came public right here, this was it went up 363% the first week. Okay. It came out at $2 and it went to 15 the first week.
Wow.
And I was blown away with it. But then it had this horribly regressive pattern.
Mm-hmm.
And I just, I just waited and waited and waited. Palo Alto Networks did the same thing. And when Palo Alto broke the downtrend, I got in and that worked great. But I trusted the CEO. That was part of that one. But I don't know if I was in this. I might have been. I can't really remember. But this bear market right here caused the peak, all of this time, all through here, earnings are going up, 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 and the stock's going nowhere.
Right.
And then the last smash down caused valuation. Now, I don't look at valuation, but the earnings are going up and the stock's coming down. And I knew what was going on. But just, can you see all these weeks? Look at that. I mean, there might be 40 weeks in here, and there was only like 4 down weeks.
Right.
I'd never seen accumulation like that in my life. I mean, I don't know if in my life, but I just piled in. I mean, I just piled and piled and piled in, but I had the confidence. The fundamentals were this: 1.5 billion people in China, 200 million online, 30,000 to 50,000 new online participants a day. The only competition, Google, was banned by the government. And if you went to Google, they rerouted you to BIDU. I'm like, I've never seen anything like this. Well, it was kind of like Broadcom for me. I had fundamentals like that there, but it just explodes out. And I just added. And I did take a position which was way, way outsized. I mean, but it just acted beautifully. It digested the 50, busts out again. I'm sure I bought some here. Digest beautifully again, busts out. Those fundamentals, there's no competition. The government is with you. The market was just going like this, and they were the only player. But on an earnings report, I think it might have been right here.
Mm-hmm.
I'm not exactly sure. They come out and say, we're changing our whole platform to accommodate new advertisers. It's called Phoenix Nest. And I had hundreds of thousands of shares. I might have had 700,000 shares. I had so much, it was unbelievable. It was the biggest position I'd ever had.
Mm-hmm.
This thing gaps down. I mean, on the day, I was down millions on this stock on the day. And I was just pulling my hair out. It broke the 50. And at that point, I didn't care about fundamentals that much anymore. I was losing, and I might have lopped off 30% of the whole thing. But in very short order, I recognized it was a shakeout. The institutions came in, and it got back above the 50, and I got right back in. And it just took off like a shot. But that was the scare of my life. I mean, I was in deep, very deep. And then the thing splits 10 for 1. Mm-hmm. So I went from 750,000 or 650. I don't know how much it was. This will tell you how, this is when you get old. Okay. I can't remember all the details exactly. This, you know how long ago this was? It's 11 years ago. So knowing not to vomit up all those shares and to try to stay with it, because I knew the fundamentals, but yet you had to get rid of some in case it was blowing. What if it topped right there? And then it just exploded out, and it actually might have gone higher. I'm going to run out of batteries here. This stock, showed insane, powerful relative strength. It had one of the greatest stories I'd ever seen. It had everything. Fidelity was gang. They were buying in every fund they had. And
Right.
I pulled this out to show you. Like, I have this book year end going back forever. I subscribed to O'Neill, but let me read these stats to you. This is why you need these books. They're so valuable. Quarterly earnings, 109, 112, 131, 46, 47, 42, 29. This is going backwards. The relative strength was not in the 90s all the way through. It had the margins, 39.8% pre-tax margin, 40% return on equity, estimates 135% in 2010, followed up by 60% in 2011. The institutions that were in this thing were all blue chip. It had everything. And my fund made 30 million on this thing. Okay. I mean, now I did take outsized risk, but rules are awesome, but you have to know when to break them. And this was you rarely, occasionally get these. Laird Hamilton would call it a rare gem of a tidal wave coming in. And I just had to get into it. I mean, guys, if I see another accumulation, look at the arrow like that again, wild horses couldn't stop me from putting 25% of my fund. I don't know about 25%, but you see that again after a bear market.
Right.
Explain to me what was going on there. It's so obvious.
Right.
So if anybody can get a copy of these things, treat them like gold bars. They're invaluable for going backwards in time. Can I give you another example?
Of course. Go for it.
Broadcom invented the high-speed semiconductor this is when the world was going from dial-up. Okay, a 64-bit modem. US Robotics had the Speedster. High speed came on. Before high speed, if you wanted to download the ESPN page, it might take 60 seconds, 180 seconds. I mean, just waiting for one page. So I knew how many people were online. I knew, again, something like 30,000 people a day were going to high speed. There was three ways. Back in the day, it was satellite, DSL, or cable modem. And I knew, it was so obvious to me, every single person was going to have high speed.
Right.
Every single satellite, DSL, and cable all used the Broadcom chip. I knew this thing was going. And I, once again, gang tackled the thing. When it had a 38% correction on a stock lockup, I didn't sell, not a single share. Came out of there, I probably added. But the point I'm trying to make is knowing the fundamentals. You have to, if you're going to take outsized risk, you need to understand deeply, intimately, every angle. Now, you can't let it overcome breaking the 50-day or breaking trend. Fundamentals don't matter anymore. But as long as it stays in trend, you got to ride that thing. When McAfee and Associates invented McAfee security for the computer, they were the first. I was in it like crazy with all my customers. A lot of them sold it up 15%. It went up 1,800% over the next 52 weeks.
Wow.
All you got to do is go, my God, how many personal computers are there? None of them have been secured. They're going to all buy it. You get these rare dynamic stories like Roku. Cord cutting is a game changer. Okay. This is a tectonic shift tidal wave. When you understand these waves, you've got to ride them. This is like surfing. That's why we have ride the wave plan. Am I beating up? Know the fundamentals. It's invaluable. If you ask Bill O'Neill, what should I do? He'd almost always invariably go back to, how well do you know the story? It's not, if you're basing all your trading on technical analysis, number one, you will not be in it long-term. You will get shaken out and you lack confidence. Confidence is what gets you through the shakeouts and the tough periods. That's why when Phoenix Nest came out and I was down, guys, it was down so much. It was enormous. I was like sweating bullets. it was the confidence to, trim a bunch, but not all of it. Dislodging stock at a great cost in a shakeout is a epic bogey failure. Apple Computer in an after hours, in the initial wave when they took the iPhone and jammed it with the iPod and they were just coming out, it gaps below the 50 in after hours, and I sold it. I talked to Bill O'Neill like a week later. He's like, you should have bought it back on the recovery. But it's up here. It's psychology. I was in fear. I was afraid of crypto when I first got rolling. My buddy Matt D'Souza forced me into it. I'm an old guy, and the risk of one digit off on the sending out $20 million, it's gone. And now Matt's passed away. I had to get comfortable with it. I've overcome my fear. Thanks a lot to Sam, who's consulting with me. Don't let fear stymie you. You've got to do new things, try new things, take risks.
Absolutely. For the last interview, I think I asked you advice for new traders. This time I want to really nail down, because it seems very clear to me that psychology is this entire game. So what kind of key psychological concepts do you think people need to realize to really achieve super performance with stocks and trading?
It's situational fluency, knowing who you are. I was an immensely insecure person. I still probably am. But I've worked on it so much. I know who I am. Everyone has flaws. The market will exploit those flaws the second you put on a trade, and the bigger the trade, the faster it exploits it. You may not know it, but the market is going to find it. It's like water finds its level. The market's going to find your weakness. But at least knowing, reviewing your trades. Why did I sell this thing right when it was about to go to Mars? Why did I hang on to it when I was clearly in a loser? What's driving you? This is the real game. Okay. Bill O'Neill's methods are written about extensively. Reminiscences of a stock operator is there for everyone to read. Anyone can screen for great names. How you handle it, it's why you handle it the way you handle it. Is it fear? Is it greed? Is it ego? There's all these flaws we all have. And, working on yourself with a therapist or reading great psychology books, which I don't, I just go see one, will help you. It's invaluable. And it goes way beyond the market. It transcends the market. Your personal life, you're getting in harmony with the world and the people in your residence, the ones you love, is dramatically improved by being situationally fluent with who you are. What's going on in your head? What were the traumas you had when you were a kid? Did your parents pick on you? It matters. It totally matters.
Awesome, Jim. Thank you so much. You've given us so many golden nuggets. I can't wait to watch this back and take some more notes. So thank you so much for everybody watching. I hope you guys enjoyed. Make sure to go and follow Jim on Twitter. He's severely underfollowed in my opinion. And leave a like down below if you enjoyed, and subscribe if you're not already. Jim, thanks so much once again. It's been awesome having you on, and you're welcome back anytime. Seriously.
Dude, thanks for having me. I want everybody to lean bullish, be optimistic. Anyone can do anything. Blockchain's the future. We're in a bull market. Follow the trend. Later.
Awesome. With that, we'll see you guys in future videos.